Hello everyone. Uh, I think from a bond market standpoint, the month of June has been a wonderful month, and of course it trickles down into the early part of July as well. So in a way, it's been raining positivity for the bond markets. The yields which started off at close to about 7% in early June and May, as we speak right now are actually trading at about 6.65%. Two events back to back. We had the monetary policy event in June, which obviously signaled a lower interest rate regime and moved the stance from neutral to accommodative, and more specifically the budget announcements, which were most awaited for this newly elected government, has actually tabled in the gross borrowing number for the bond markets at INR 7.1 trillion or 7.1 lakh crores. This clearly means that the government is wanting to keep or wanting to toe the line of fiscal discipline and not really go completely philanthropic at the cost of impacting bond yields. Alongside that, I think what is the other big positive is that the liquidity situation in the banking system also has been morphing itself to negative, marginally positive, to little bit on the surplus zone. As we speak right now, banking system liquidity is close to rupees 1.5 lakh crores, which also has acted as a very strong factor in supporting bond yields. We also have seen the inflation numbers all along in India, which don't seem to be very threatening at this point in time. If I add to this the global sentiments, globally the things are pointing to a sluggish economic growth, which means even countries like US, China, Japan, the Eurozone, all of them are seemingly different sectors are in a lull mode. Globally, the negative yields have touched close to $13 trillion, which indicates that world central bankers may need to pump in more steroids to pump prime the economy. In such a scenario, it is very difficult to expect immediate inflationary tendencies in a country like India, which also is seeing a sluggish growth, and therefore the budget has also focused on what kind of impetus that can be provided to stimulate the growth cycle back to get us on to the path of 7% plus GDP growth and beyond. So what does all this mean from a bond market standpoint, and what can we expect going forward? Clearly, the biggest concern from a bond market standpoint with respect to the government borrowing program seems to have been allayed for now. Additionally, the talk of raising sovereign bonds from outside of India, which is overseas, is also a positive development. We need to see the fine print to see how the modus operandi will operate, but clearly it is a step in the right direction. Foreign portfolio investors for the month of June were net positive into Indian fixed income to the tune of about rupees 6,000 crores, which means this is the first time in calendar year 2019 that the foreign inflows in fixed income have outpaced the foreign inflows in equity, which was about 1,000 crores in the month of June. Going forward, we believe that rate cut expectations being on target or being in line, given that we are now in an accommodative monetary policy region, will continue to be a strong anchor for bond yields going forward. Given the kind of run-up that we've seen in the last 30 to 45 days, it is natural to see some small profit taking, but we are not going to be overtly disturbed by that. We believe that on an incremental basis, we would see yields gradually easing. That clearly makes a case for staying invested into categories beyond liquid fund, which includes the ultra short term all the way up to bond and gilt funds. But clearly, as you make this investment journey, keep in mind the intended investment horizon. If you are a very short-term investor, fixed income offers solutions even for investors such as you. Needless to say, given the favorable expectation on interest rates, we continue to focus and maintain that strategies like short-term corporate bond fund and the PSU bond fund would be the cluster of strategies to focus on. For those who are willing to ride the investment interest rate cycle along, strategies like the dynamic bond fund and bond strategies, which is a play of corporate bonds, high grade and government bonds, would be the way to go forward. We believe that the credit environment should soon stabilize, so while the spreads remain elevated, it is unlikely that the spreads will show compression in the very near future. That itself poses an opportunity to position yourself around corporate bond kind of strategies which hold high grade bonds. On an asset allocation, I think one can continue to own equities and fixed income together as part of the portfolio, notwithstanding the recent volatilities that we have seen along. On that note, happy investing. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.